Hello and welcome to this Lunchtime Live with Interactive Investor. I'm Merryn Somerset Webb, and today we are going to be talking bonds versus equities. Where should income investors turn? Now, before we get started and before I introduce our guests, just to let you know that we would love it if you would ask questions. We've had quite a lot come in already. If you look at your screen, you can see there is a QR code. You can use that to go straight to Slido, where we are taking questions. If you don't want to use the QR code, underneath the screen, kind of underneath me, there should be a link that you can also use to get to Slido and ask questions. So please do that. We're going to be talking for about 45 minutes, and I'm hoping to leave at least 20 minutes of that to take your questions and put them to our expert panel today. And I hope you will get the answers that you might not want, but which will be useful to you. Right, on to my panel. On my left, we have Sam Benstead, who is the Deputy Collectives Editor here at II. Next to him, we have Charlotte Harington, who is a multi-asset portfolio manager at Fidelity. And finally, here on my left, Paola, who is a bond portfolio manager at Royal London. Thank you, all three of you, for joining us today. Now, we're going to have to start, I think, by setting a bit of a macro scene. We are talking about income largely because we have such high levels of inflation, and the higher inflation goes, the more desperate we are to somehow find a way to beat it, and getting a reasonable income from our investments is a good part of that. Now, predicting inflation at the moment is verging on impossible. Everybody has got it completely wrong for the last couple of years. Well, not everybody, a few outliers, but the Bank of England possibly the worst predictor of inflation so far. So I'm hoping that from you I can get something better than I can get from the Bank of England. It's a low bar. Paola, can I start with you? Where do you think we're going from here? And we all know, I think, at this point, how we got here. But what happens next?
Well, I think that inflation will probably be stickier than the central banks are predicting, particularly the Bank of England. I think, don't bet against the central banks over the longer term. Mm-hmm. I think they will get inflation down, but first of all, we've got to see signs of weakness in the employment market. So if you start seeing unemployment creep up, then I think you could have some sort of meaningful impact on inflation. So when I talked to our economist at Royal London, she's expecting inflation to fall around to 4%, sort of ballpark in the UK. In the US, we would expect the next 2 to 3 years 2%. So when you look at, I'm jumping a bit ahead here. When you look at yields in bonds, you're thinking about the longer term. If you're investing in the longer term, then you could probably lock in some attractive yields.
But let's go back a bit then. Why higher here than in the US?
Oh, I think there are many factors. I mean, we are closer to the war in Ukraine. Mm-hmm. I think also Brexit and the impact on food prices. Mm-hmm. Also, you've had a drought in Europe, in southern Europe, where we get a lot of our fruit. And we are stickier on employment in terms of we have full employment in the UK. There are a lot of people that have been long-term absent from the employment market, which is making it very tight. So, if consumers, this is just my theory, but if you're a consumer and you have a job, and your savings you've accrued over a COVID period when we couldn't travel, couldn't do much, you're going to be spending money still. I mean, the impact of interest rates will come through. So as you refix your mortgage, which 2 years ago you could fix at 1% and you're now fixing at 5%, it will impact the spending power of consumers. But these things take time to come through.
So bit by bit, those savings will be run down. I mean, they must be getting pretty close to being run down by now.
No.
People are still seeing real falls in their wages. I mean, wages are going up quite dramatically at the moment, sort of running at about 7% into the end of the year. That's still lower than inflation.
Yes.
And the impact of interest rate rises hasn't yet hit. And we tend to assume what kind of an 18-month lag in between an interest rate rise and its effect, and possibly even longer at the moment because so many mortgages are fixed.
Yeah.
So we're not really going to see it for a while.
No, the savings is coming down, but we're still above pre-sort of COVID levels in terms of consumers and corporates in particular. So I think it's also when you think about inflation, you're getting your energy prices coming down. Mm-hmm. So what the economists will call your base effect is starting to come down. So as inflation, as your wages go up, your inflation will come down. So actually the spending power of the consumer over the medium term will actually improve from here on. It's been very negative up until this point, obviously, but if you expect inflation to start to trend lower and you've seen this, rise in wages, then that's good for the consumer.
Okay.
So it's not all negative. I think the press always paint this very negative picture, cost of living crisis.
We like a bad news story.
But actually, the economies have all surprised on the upside. They've actually been stronger.
Yeah.
If you read the headlines, you'd think that we're all impoverished, which obviously some people are, but it's just not as bad as painted by the press, I think, and that's just come through on GDP numbers.
Okay, so your base case is a gentle fall to 4%, and then something quite steady.
Yeah,
4%, a steady inflation rate at 4% would be, obviously it's not what central banks like to think they like, but it's not awful, is it? That's quite good. It erodes our public debt a bit, it erodes our private debt, it's not high enough to be particularly detrimental to anything. So a flat 4% would be fine, but it might be rather more volatile. An average of 4.
I don't think the central banks would agree with you. I think they're still sticking to their hard target of 2%. I think it would send a dangerous signal if they all turn around and said, well, actually, just what you said. Then you would.
They wish they could, though.
Yeah, because then you'd have much more pressure on wages.
Yeah, Charlotte.
I think for me, in the round, sort of high level, I think we should be quite encouraged that inflation will start to come down, and actually has started to come down. There are sort of, in a sense, two ways to think about it, really. The first one is, and you've touched on, and I might come back to, is the sort of the regional differences in inflation, and the UK really does stand out, and come back to that. But on a more global basis, when we think about inflation, we're really thinking about sort of goods price inflation and service price inflation. On the goods prices side of things, I think we are seeing very encouraging signs there. You see a sort of quite a disinflationary impulse really coming out of China. Goods spending is starting to drop off post pandemic. The services bit is proving a bit harder, and that's the link to unemployment. So I think whilst I sort of agree with you in the sense that we can see a better picture for wages or real wage growth as inflation comes down but wages stay high, that works until unemployment starts rising. And when we look at sort of unemployment metrics, actually, we're kind of off the lows here in many places. Not the UK. The last report was a little bit softer. We're starting to see signs in the US that the labour market's starting to produce some slack. Wages have come down. Weekly hours worked tends to be a very good leading indicator. That's starting to come down. So
in the US.
Yeah. So I think from a global perspective, we should have sort of confidence that policy tightening works and that inflation will start to come down. Different countries have had different degrees of inflation impulse from different sources. So the Ukraine point, demand in the US was very strong. Touching on the UK, so I think year to date, I've sort of mentioned this kind of more positive outlook on inflation, and that's coming through in the data, and it hasn't really in the UK, and the UK has surprised everyone, including myself. But I don't think we should give up on the fact that that won't come through. The reality is mortgage rates are much more fixed than they used to be, and there's something like 75% of the tightening is still to come through in the UK. So I do worry in the UK that as we all focus primarily talking about inflation, we might wake up one day and be talking about a recession and much, much less inflation. And so again, I think that the stars are aligned here. The big question for us as investors, I think, is how fast that comes to pass. We've been talking about recession risk for a long time, and at every opportunity the can gets kicked in terms of when it might start. But I suspect when it starts, there won't be an awful lot of sort of notice. It will just be quite abrupt potentially, and then the unemployment rate is really, as I say, the kind of last piece of the jigsaw here for sort of nailing that kind of services sticky part of inflation pretty much everywhere.
But when you look at UK numbers on unemployment now, we've still got 1 million plus vacancies. We've got a historically low unemployment rate, even though of course we have a lot of people who aren't engaged with employment.
No, so vacancies have come down. It is true that they are still relatively high, but they've come down quite a lot from the peaks. We are seeing much more flow of workers into the UK. The number of people who have been off sick has been very high. It is starting to decline. None of this is done, and unemployment is still low, as you say. But I think the trends are the right trends. So yes, I would say that the supply side is an issue, but the signs of late have been more positive.
Okay, so if you had to take a rough stab at when we might get back to 2%.
Well, I'm in the fortunate position of not having to do that and not having to make forecasts.
Look, you can't be worse than everybody else. It's not possible.
Well, I'll go with the Ireland forecast then. But I think
that's good.
But look, for markets, the exact pinpointing of when we get to 2% isn't really the point. The point is, what's the direction of travel? How is policy going to respond to that? And how is the growth and inflation trade-off? How is that playing out? I think that's much more important than pinpointing the sort of exact numbers.
Spoil sport.
Yes, I'm sorry.
That's right, Sam. I won't ask you to predict inflation. Right. Let's move then to how we deal with this. So, Paola, here we are. We've got possibly volatile, definitely slightly higher inflation than the Bank of England would like, than any of us would like. How does a bond portfolio help us deal with that? Big, wide question for you. You can take from whatever angle you like.
Well, I invest in corporate bonds, and what you've actually seen is a huge adjustment in yields. And we saw that last year when your bond portfolio unfortunately gave returns of minus 20%, the sort of returns you might expect from something that was volatile. In fact, it was a bit of a shock for a lot of investors because as you come closer to retirement, the norm is that you put your savings into bonds and you think that they're safe and they're going to generate an income. But if you're taking a capital loss of 20%, which you saw last year, I mean, sort of generically, that was a big shock. So coming into this year, at least yields on government bonds were starting to adjust for these high inflation, and if you get on top of that an additional yield on a corporate bond, you can get up to 2%. You can even, if you want to take a lot of risk, go into high yield, and you can get 9%. So
you're still not getting 10%, are you? You're still only knocking around inflation.
No, but the whole point is when we've seen a lot of interest, and it's true that the market's seen a lot of flows into government bonds, and the reason they're buying government bonds is because you can lock in 20-year interest rates at 4.5. Now, you're making an assumption that this rise in inflation is a post-COVID, possibly impacted by Ukraine, etc. But it's not going to be there forever. So if you believe that the central banks will get eventually inflation under control, and inflation goes to, say, even if it's 3 years' time, to 2% or something close to that, and you've locked in 4.5, what is called the risk-free rate, so you're not taking a lot of risk buying government bonds, and you're retiring, that actually generates a lot of income. And when you look at where interest rates were 2 years ago, 3 years ago, they were like rock bottom. If you got 1% on a government bond, that was on a 30-year or 40-year government bond, people were buying bonds at those levels.
But that seemed nuts at the time. But people did it anyway.
People had to do it. I mean, there are various reasons why you have to buy it. But if you want to lock in an income, and at that point you need to lock in an income, you may not want to lock in all of it, but you have to make some investment because the point is that the rates kept falling. So people are kind of sucked into buying government bonds at ridiculously low levels.
Yeah, but an ordinary retail investor wouldn't have done that.
Of course not.
Our viewers today, you lot wouldn't have done that, definitely. But you might do it now.
You might do it now because if you can get 4.5% for 20 years, when you think how much capital you needed to retire 3 years ago, but I did this equation myself, this calculation, I was thinking how much money do I need to generate income? And if rates are at 1%, that's a lot of money that you need to generate any income. Now it's a bit like your mortgage rate, except in the reverse. So you're getting 5 times that on your capital, so you actually don't need as much capital anymore. And it's why we've seen big demand for long-term interest rate products. People are starting to look at annuities as a kind of, as a credible...
This is particularly interesting, isn't it? We've been through a long period when no one wanted to touch an annuity with a barge pole because the rates were so low. You're handing over such a huge amount of money for a tiny income stream in return.
Absolutely.
And you just think, well, why would I want to do that? And we had this reform that meant you don't have to do it anymore with your pension income, so with your pension pot, so why would you? But now, as you say, suddenly it's beginning to look like that's not the worst idea in the world. And I don't know if we'll get questions on this, but a lot of people have been asking, should I buy an annuity with part of my money and hold the rest house back and have a halfway house.
Well, I think annuities now, I mean, not that I've got any vested
Anyway,
interest
that
in
age, of course.
in age or even the product, but I mean, it makes sense if you're time, because your interest rates that you're getting are a lot more attractive than they have been in the past, and your capital can work much harder. Now, it's true that you won't beat inflation, but inflation basket, not that I'm an expert, is it's some things will be, you'll be impacted the individual more than others. It's not actually a measure of inflation for every individual. And I think the central banks will win. The central banks normally do.
If the environment is working with them along the way. Charlotte, I guess you're itching to jump in here.
Well, no, I just think it's sort of the post-COVID world is just so different to the pre-COVID world. You think pre-COVID, as you were saying, government bond rates at 1%. The sort of world of low growth, low inflation, low policy rates pushed income investors out into riskier parts of asset classes. So you had to go and buy an equity, say, to get that income. And as that sort of matured, you became less and less. You had less and less of a cushion from a volatility perspective of the underlying assets. So spreads on high yield bonds became very, very tight. Well, it's sort of now we've got the exact reverse of that. These kind of traditionally less volatile income producing assets are finally offering a very comparable income. And so the question becomes why would you take the unnecessary underlying volatility when you can get the income from those traditional asset classes? I do think, though, on a sort of more medium to long term view, you do have to be tactical about this stuff. I'm hopeful and have outlined why I think that inflation will come down and policy rates will ultimately be cut. Rates are just so far above sort of long-term potential growth. That's not to say that you can't get another resurgence of inflation. We could be in a world now where policy cycles are a bit shorter and you get this inflation volatility. So I don't think this is about sort of buy and hold forever, but I think that's the lay of the land as we see it today.
Volatility in inflation does seem to me to be the big risk.
And we won't know that till for a while. So some of that depends on how deep this recession is. And how deflationary it is. There's also a lot going on in sort of commodity markets on the supply side of things. There are lots of dynamics that play into this, and it's, I think, a bit early to sort of hang your hat on one side or another. But at least as it stands today, you do get cash rates are pretty impressive, government bond rates are pretty impressive, and so there's a kind of natural draw into bonds versus equity.
It's quite exciting. Quite exciting for savers to suddenly find they can get 4% on a bank account. And that might be one reason why you aren't seeing flows into any investments that you might have expected at a time like this, because people are just hanging on to cash. So can we look at the case for high yielding equities then as an inflation hedge?
I think so. Not all equities are the same. So if we think about it from a sector perspective, then you've got sectors like the utility sector, even the energy sector, certainly in the US, are quite high income sectors. More growthy sectors and technology, consumer discretionary and so on are much lower income, and that obviously explains why the US equity market is such a low dividend yielding market. It's very heavy in these sort of tech stocks. So you sort of pick your markets here, but I do think as well you need to take into account the broader global backdrop. Utilities tend to be quite defensive, and so I think you've got an income there in a not too cyclical underlying sort of asset, if you like. But other markets that are high yielding, there might be some underlying risk there. So whether it be leverage or perhaps not so good balance sheets, or exposure to commodity cycles, or whatever it is, there I think you just have to be much more selective.
But if you look at, say, let's just take the UK market. History tells us that in periods of inflation, if you buy stuff that's cheap at the beginning of the inflationary incident, you tend to do better than if you buy stuff that is expensive at the beginning of the inflationary incident. A very simple way of looking at things. But the UK market then is reasonably cheap and offers a reasonably high yield. That seems like if you're going to be looking around picking regional markets, that would seem like a good place to start.
Yeah, no, I think that's absolutely fair. As I say, the US is the sort of stark opposite to that. But from an income perspective, the UK has been for a long time, so it's got a lot of banks, commodity sensitives and consumer staples in it, in the FTSE All Share at least. So that is, I think, a very good income generating equity market.
Oh, that's not a globally shared view, is it? Because the UK doesn't seem very popular.
It comes and goes. It does seem to have been in somewhat of a structural decline for a while, but.
Okay, so outside utilities, and what area of equities would you look at?
Well, utilities and staples probably because of the view that we have around the sort of likelihood that actually not only are we going to have a recession, but probably need some sort of recession or need quite a severe growth slowdown in order to get this inflation under control, then you are looking at the sort of more defensive parts of the market. So it actually would probably steer away a little bit from sort of some of these more cyclical banks and minings. And you've got, for the banks, you've got huge tightening in credit conditions underway that and they are very economically sensitive. And mining, as I say, you've sort of got this exposure to basically metals and China, and I don't think we're seeing any great enormous growth recovery out of China, even after zero COVID's ended.
Sam, what are your investors looking at the moment? I know that interactive investors are...
They're doing a lot of things when it comes to income, and income is a big theme we're seeing editorially and in terms of fund flows and stock flows. So if we just look at the most popular shares at the moment, we have names like Legal & General, 8% yield on that, Lloyd's about 5%, Vodafone's there, BP, Glencore, Rio Tinto, Aviva. So there really is a focus.
Not exactly an ESG fund, is it?
It's not exactly an ESG fund. It's an income fund. If you look what people are buying, it's shares that pay big dividends, and they're generally UK shares. You're not seeing American tech stocks being bought en masse at the moment. The focus for our customers is income.
Although Scottish Mortgage is pretty much always in your top 10, isn't it?
If we're looking at trusts, that will always be in the top 10. But actually, data for the past 6 months show that 7 of the top 10 most bought investment trusts yield more than 2.4%. So that's kind of above global equities just about. So yeah, Greencoat UK wins an income trust. BlackRock World Mining is very popular at the moment. City of London, Merchants Trust, Murray International, JP Morgan Global Growth and Income, Alliance Trust. There really is a focus on income for II customers. I think it just shows how important an investment portfolio is to actually help fund a lifestyle, to help fund a retirement. On the fund side, it's a bit different. I mean, investment trusts can hold back 15% of their income each year to then kind of smooth out the years where they're not picking up so much income.
Yeah, and this is one of the things that a lot of those big income trusts do, is they're really careful to make sure their dividend goes up every single year, even if it's from a
and that's why they're so
base,
popular.
so that you know that you've got a little bit of inflation hedging built in when you're buying those things.
And they understand their audience. People buy these trusts for that income, and it's really important to people.
Sort of almost an annuity, aren't they?
They're similar. You're buying into that security of income in the way that a fund can't do. And if you look at our top trusts versus our top funds, the top trusts are focused towards income with a few exceptions. The top funds are more about global equities and growth, and there's only one dividend fund in there, and that's the Fidelity Global Dividend. That's more of a dividend growth fund rather than a high yielding today fund.
And then money market funds are a new area for your investors, right? No
Yeah.
one touched those a few years ago, but now they're quite popular.
Exactly. You can get 4% income from money market funds. So the one that's been really popular on the platform is the Royal London Short-Term Money Market Fund. That's regularly appearing in the top 10. And like you said, you wouldn't have seen that a year ago because it wouldn't have paid you anything. There would have been no point. You might as well have held the money in your bank account. But now you can get paid a good rate on your cash. And we've seen customers move into buy funds like that.
And the Royal London one, does that have a slightly higher yield than most of the others? What makes it more attractive than the other short-term money market funds?
I think it's to do with its size. It's big. The charge is 0.1%, I think, in it. So it's big, it's cheap, it's got a great track record, and the yield is towards the top of the range of money market funds. The other ones that are popular are the Legal & General Cash Trust and the Aberdeen Sterling Money Market Fund.
And what about if people just hold cash in their accounts at II? How does that work out for them?
Yeah, so we pay an income on the cash. I'm not sure of the exact details, but yeah, we do pay an income on the cash as well. So you do get a return just by holding the cash. You get more return if you were going to put that into a money market fund.
Okay, can we go back a little multi-asset and talk about how you might divide up a portfolio now? In the days of 60-40, we're told are long gone, but are they really?
I think, well, first of all, sort of the principles still hold, which is that diversification is a good thing, and I know that last year was not so good for a diversified portfolio, but on a medium longer term view, diversification is a volatility dampener, and tilting around those sort of structural elements of it is also a good, I think, and useful thing to do. In terms of 60-40 portfolios and how badly they did, essentially what you saw was equities selling off as bonds sold off. So the correlation, which is really what you rely on for this diversification benefit, that kind of negative correlation that you want, wasn't there. Now, I don't think that's a new thing that doesn't go back to where it was. That was very specific in the sense that you had very high inflation and very aggressive policy at the same time. The policy piece really sort of drove everything, and as we saw with many parts of the market, including linkers, the sort of fighting inflation was more important than the inflation itself, essentially. As we move into a world when policy is probably more, gets towards the end of this hiking cycle, they start to think about easing policy, and actually even year to date you've seen that correlation come back to something a bit more normal, then the benefits of a 60-40 portfolio or a diversified portfolio between equities and bonds really sort of reasserts itself. So for me, diversification is key, whether it be sort of for returns, capital returns, or income. And the advantage of being able to do that is you can be more nimble as well across those different asset classes.
Okay. You mentioned linkers. Paola, can I just bring you back to that? I think a lot of people were quite disappointed with their index-linked gilts last year. What happened there?
Well, it was pretty torrid for index-linked investors.
They were supposed to be the safest thing out there, the thing that would protect us from everything, and it rather let us down.
Yeah, if you talk to our index-linked trader or investor at Royal London, he'll always say that investors make the mistake that they think that you can buy an index-linked bond and that you will be protected against inflation. But actually, index-linked bonds tend to have very high interest rate sensitivity, because they tend to be very long dated and they have very high cash prices. So if interest rates go up, they're actually more impacted than some conventional gilts. So what we saw last year was, the longest dated bond, I think, in the index linked market lost 70% of its value, which was a bit of a shock.
Yes.
And this was exacerbated also by what happened during LDI, where LDI investors had been heavily into the index linked market. And when they had to unwind their positions, that just put more pressure on index-linked prices.
And maybe some people watching you don't know what LDI is, so can we just make it a shorthand for trust chaos?
Yeah, it's hedging on pension funds. So pension funds had to hedge, and as interest rates went up, they had to release cash from their investments against some of the derivative positions they had. I mean, so it's sort of a bit complicated. Basically meant they had to sell a lot of government bonds and a lot of corporate bonds as well. And so we saw huge spikes in interest rates in government bonds on the back of this.
Yeah. Now this will have put a lot of people off buying index-linked gilts. Is that
well? I think you have to be careful.
or not?
You have to be careful where you buy index-linked bonds. I think, if you have to have a strong view that you think interest rates are going to fall, if you want to buy long-dated index-linked bonds, and also index-linked bonds traditionally were, because of all this liability-driven investment in index-linked bonds, they got very expensive, so they actually gave you a negative real rate of return. So locking in an interest rate on an index-linked bond means you were guaranteed to lose money compared to inflation. After the big sell-off during October with the budget, etc., Liz Truss and all that, because of the forced selling, they actually now offer you positive return first. So you're actually you can lock in a positive return at the short end versus your inflation rate. But I would just be very hesitant about buying longer dated inflation-linked bonds, because it can be volatile, especially if interest rates start to get volatile.
Volatile, to put it mildly.
Yeah, so you can lose a lot of money at the long end. But if you're buying 3 to 5 years and you think that inflation is going to be sticky and you're getting a positive real return on those bonds, they're actually not a bad investment.
Okay, brilliant. Right, we've got quite a lot of questions coming in, so if you don't mind, we'll move on to a few of those. Do keep sending them in. We've got about 15 minutes, so if you have a burning question you haven't asked yet, do feel free to ask it. We will try and squeeze it in. I'm going to start with the most popular ones, because just to mean that they can like them, so we can see which ones most people want answered. this is really about equity markets, so I'm sorry, I'm pitching it to you, Charlotte. Has the S&P 500 index run out of steam? Well, quite clearly it hasn't been running out of steam this year so far, but how does it look to you over the rest of the year? We know that it's a very, very narrow focus at the moment.
Yeah, so that's exactly what I was going to say, which is that a real handful of stocks have driven the equity market. Actually, not just in the US. You also see that sort of lack of breadth in the European markets as well. Some of it does start to feel a bit like the sort of meme stock craze, and you do slightly think this is a bit of evidence that financial exuberance hasn't yet been squashed from the system. But that's the picture we have. Is we've had this extremely big rally in anything that sort of has anything to do with AI, with some particular stocks at the front of that. I think for us the macro data is key here, and if we're right to think that the labour market will weaken and that there will be job losses as a result of that, then these equity markets, which are inherently growth sensitive, I think it is quite hard to really be sort of buying into a new bull market here. My sense is exactly as you said at the beginning, which is that there's no evidence that the central bankers have given up on their 2% inflation target, and the framework they're working to is one that says they need to see, they're not going to predict, they need to see the evidence that allows them to be confident that they are going back to 2%. And almost by definition, they are telling you they want to be behind the movement of the market. So there will be an opportunity to buy equities, but I think here and now, given the low breadth, given the kind of broader macro dynamics, we are underweight equities and would not be chasing this sort of rally.
Okay, so the second part of the question here is, if the S&P 500 has run out of steam and is running out of steam, and I think we'll call that a yes, paraphrase that to a yes, is the FTSE all worldwide index, all world index better? And I guess your answer to that would be, well, all equities are much in an environment like this.
Yeah, so I think when you get very big risk-off moves, you get sort of an indiscriminate type selling. Things that are crowded tend to sell off more. And there's not really a huge amount of rationality behind that, except people own it and they don't want it anymore. And COVID was an example of this. Of course, we had absolute, things were very positioning-led or, news flow-led. And it's quite hard to sort of nuance those types of environments. They tend not to be that long-lived and come about very quickly. So, if you're underweight equities in aggregate, there's no reason to, within that, say, but I'll own the UK. Can the UK be a relative outperformer to the US? I think that's entirely possible. But I do think a lot here also comes down to the currency. So the UK market tends to do well when the currency is weaker. So you can get some relative outperformance there just from the currency effect.
Okay. Anything to add to that? Not so much your area.
Not so much my area, but I would say that the equity market in the US is looking very frothy. And there are some technicals that are supporting these AI stocks. And Nvidia, that I think it went up 150 billion in one day. It just feels like exuberance, and
you have to wonder, where does that exuberance come from at the moment?
It's the valuation of some of these stocks. Like I think Tesla, I remember looking at it last year, and it was the valuation of Tesla was the same as the auto industry in its entirety, less Tesla. So these valuations look pretty extreme. And also the technicals, like if you're underweight these stocks and they're going up so much, I mean, it's that Nvidia's up over 100% on the year, then that's a powerful for passive funds. They first of all they have to buy. As the valuation increases, you have to buy more. If you're underweight, you're increasing your underweight by extreme amounts. So it does feel a very technical, slightly frothy market, but dangerous to be short if you're an investor that has to participate in those markets.
This is one of the dangers inherent in the rise of passive investing, isn't it? That you get these momentum swings.
And I think actually a lot of that explains the year-to-date performance of equity markets, because there's a sort of frustration that people have been waiting for this recession and they don't feel like they're really, it's not here, it's not sort of in your face that you can't deny it sort of thing. And so that, I think there's been this sort of climbing a wall of worry, technical part chasing sort of market moves that's driven a lot of this. But something like Nvidia, I think, has priced in something like 200 years worth of earnings. Well, a lot has to go right from here, and there are a lot of things that could go wrong. So I think, you know,
you're
a
not
bit
holding it
caution
then.
I mean, passive investing is huge for
Yeah.
customers. Most of the most pot funds are actually passive funds at the moment. And I think people have realised there will be winners that will appear out of nowhere, and just by owning an S&P tracker, they get exposure to them. And over long periods, passive funds have outperformed active funds, and things have been very volatile. And actually, they've taken a step back and said, "I'd rather just own the market rather than trying to pick winning active funds." And so far this year, that's been the right thing to do.
Yeah. So when you say they're buying passive, do you really mean they're buying passive in the US?
They're buying passive global, they're buying passive UK, they're buying passive in the US, they're buying life strategy funds. I would say they're allocating their money towards passive funds with maybe, no, I wouldn't even say they're overweight US. We see FTSE trackers and S&P trackers in the most bought tracker funds month on month. So it's a general investment approach rather than taking a bet on the US.
Okay, the next popular question is probably for you, Sam. This very lucky person has an enormous amount of cash in their II SIP. They're £500,000, congratulations, sitting in their II SIP, and they want to know, they want to be sure it's protected over the £85,000 deposit protection limit. What's the best way to keep that cash with no risk of loss to capital?
I mean, if it's in a fund, that 85,000 limit doesn't apply.
It's not in a fund. I think he's literally holding it in cash in his wrapper. And that might bring you back to money market funds.
I think you'd move it to a money market fund, and then you're putting the risk onto the fund manager.
Yeah.
If these big money market funds blow up, there's big problems happening across the whole economy. It's very, very unlikely.
Yeah.
Move into a money market fund. Royal London short-term money market is the most popular one at the moment. Yields about 4%. You can take income, or you can reinvest that income, choosing depending on the share class you choose.
Now here's another one. I imagine this is a very common problem, and it's probably for you, Paola. This investor is holding two bond funds. One of them has fallen 17% from its peak, and the other has fallen 22% down. He's feeling a bit depressed about that. How long before they'll recover?
That's a very good question.
An unanswerable one, I know, but give it a go.
Well, I mean, on a very basic level, you just have to look at what sort of yields that you're getting on those funds. And if you're getting somewhere between 4 and 6, depending on what they're invested in. So if it's a government bond fund, it'll be around 4%. If you're taking a bit more risk, you can get 6. If you're taking more risk, you get 9. So if that implies that it'll take 3 or 4 years before you get your losses back.
Yeah,
and if
in nominal terms.
Yeah, it's just you're just looking at the yields, and then you thinking, well, if inflation does start to come down, then you'll get capital appreciation. But if you assume there's no capital appreciation, you're just locking in some, your returns that just the coupons that you're getting on those bonds. It'll take 3 or 4 years, just roughly speaking. But I mean, it could be better than that. It could be worse if you get sticky inflation. And we don't see any moves in interest rates, and they stay elevated for a longer period of time than the market's expecting, then it's going to take you longer to get your cash back.
It's interesting. It's useful to think of the yields in that sense, isn't it? As converting themselves into capital along the way. And we often say when we're looking at equities with good dividend yields that's where your protection is. So, if your capital value of your equities fall by 10%, if your yield is 5%, you're still, it's not so bad.
No, because you can claw back through income.
Claw it back through the income over the years.
Yeah.
There's a couple of questions that are taking us back to index-linked gilts. I think we've sort of answered this, but if you were in this environment, what are the panel's thoughts on choosing index-linked rather than conventional? You've slightly answered that, but you may have something to add.
Yeah, I guess so. I think real rates are quite attractive here. But there is also a bit of a sort of risk beta to index-linked bonds. So I think if you've got a very big risk-off moment where equities really underperformed, in the short run, index-linked bonds can trade with that kind of almost like a lack of liquidity type environment. But beyond those very sort of short-term type moves, I think real yields are attractive here. But as we've already said, it's really about the policy rate outlook much more so than it is about the inflation outlook. They're great when policy is doing nothing and inflation is high, but as soon as policy starts to fight that inflation, you're fighting against that kind of interest rate risk.
What about, here's another question that hasn't come up for a good few years. I don't remember writing about this for at least 7 or 8 years. Preference shares. Is there any space for those in your portfolio?
It's not an area that we, specifically look at, I have to say. So we'd be much more focused on sort of different regions, different sectors when it comes to equities, and then also allocating to things like alternatives, where you have sort of attractive yields, but also slightly uncorrelated asset class. So don't have a huge amount to add on preference shares.
We sometimes invest in preference shares in sort of bond format, and the returns you can get can be quite attractive, but they are illiquid. But the attraction for investors is that you can buy in 1,000 lots. So typically, if you want to buy a corporate bond that I invest in as a fund manager, you have to have 250 or 100,000 pounds or 200,000 pounds
per bond.
Yeah. So with a preference share, you can invest much lower amounts than that.
Okay, so you can get bond-like characteristics. At a lower entry price.
Yeah, absolutely. Well, yes, the entry price will vary depending on the risk of
yes,
the
but I mean
underlying
ability to enter.
Yes, absolutely.
Price.
Yes, exactly.
That's the wrong way around. We're back to annuities. This is, again, a popular question. Lots of income seekers, in fact probably most income seekers are retirees. Should they be looking to lock in current yields with an annuity? And we touched on this earlier, and you slightly believe that it's definitely worth looking at the moment.
I think it's definitely worth looking at. I don't think I'd put all my eggs in one basket. I'd want to have a bit of flexibility, because if inflation is stickier than we're predicting, say if the war in Ukraine escalates and I mean the dam bombing is obviously not good for food prices potentially over the short term, then you can lock in at least partially at these interest rate levels. I mean, we peaked actually in interest rates globally in October last year. So we're not at the peak levels that we saw in October. In the UK, we kind of underperformed a bit, so interest rates are still high in the UK. But I think it's actually probably worth locking in, because at the moment. But I wouldn't put all my eggs in one basket at the moment.
Okay. All right, we've got lots more coming in. But some of them I think we've already answered. I like this kind of thing. How much of my portfolio should I allocate to more risky assets like private equity? Are interactive investors buying into the private equity trust at the moment?
I mean, there
great
are
discounts.
Like you said, there are massive discounts on private equity trusts. I think some around 50% at the moment. And a lot of the brokers have come out and said these are now good value. You're looking at trusts with excellent long-term track records, and they're investing in good, high-quality businesses. I can't tell you if we see money going into it, but for bargain hunters, a 50% discount, those are historic lows, and that should ring that should flash green for a lot of people that are bargain hunters. So historic lows on discounts could be a good investment. Who knows where they go from here?
We don't know what is a 50% discount to, because we're not entirely sure what the
exactly.
really
So
are.
These trusts estimate the value of their unlisted holdings, and then investors are saying, actually, we don't believe you, therefore we're going to put this at a huge discount. They're normally conservative, is the line from these private equity portfolio managers. So that 50% discount looks extra appealing if their valuations are conservative. Who knows where valuations go from here? Who knows where discounts go from here? But if you're a bargain hunter, maybe take a look at them.
Yeah, not for income investors though. Is there any room for private equity in a portfolio like yours?
I mean, again, I think this sort of comes back to the alternative space. I think you want to diversify your holdings within alternatives. The same principles apply, and so that would be what I'd say. I don't just go and buy one alternative and put all your money into that. It's essentially the key message. You need the underlying assets, not to be overly leveraged, for example, in this high interest rate environment. So they are all very different, and so that's probably what I would say. Be selective.
Always be selective. Should we stick with alternatives for a moment, because there's quite a few ways to invest in alternatives that come with a high income. You mentioned Greencoat earlier. Are there others that your clients finding interesting?
Yeah, so Greencoat is the most popular one in terms of alternatives that appear in the top 10 most bought trusts. So that buys wind assets across the UK. There are other environmental infrastructure assets that appear. So JLEN Environmental Markets is one of them. taken as a sector, so this is data from the end of March, and so the end of April, and the renewable infrastructure sector yielded 5.8% on average. So that's above the 5.5% from standard infrastructure, above 5.5% for corporate bonds, above about 4% for gilts. So those are attractive yields, and you're often buying these trusts at discounts as well. So Greencoat's on about a 10% discount, so you're buying those assets, which
a 10% discount with a yield of
about 5.5%.
5.5%.
Yeah. So for many people, that's attractive, and these have historically traded at premiums because they own these very appealing renewable energy assets. There's obviously lots of demand there. So yeah, that's why we've seen it rise up the ranks, because you're getting that income, and you could be getting a bargain as well.
Okay, brilliant. We are, I'm afraid, coming to the end of our time, so I think we're going to have to call a halt. But before we go, I tell you what, quick fire round. You all know the answers. If you could only hold either bonds or equities over the next 5-year period, which would it be?
I'd probably hold bonds.
Well, you've had to
Yeah, of course.
You've got a bit more flexibility.
A bit more flexibility, and I would also say bonds.
Oh, really? Over 5 years? If I made it 10?
Well, it's way out of my time horizon scope. But,
Sorry, we're not going to hold you to this. Why are we going to put it on Twitter? Nothing. Sam?
Equities. So many exciting themes at the moment. Earnings should grow with inflation. Yeah, US shares are expensive, but they've always been expensive and they've always done very well.
Brilliant. Thank you. Thank you, all three of you. And thank you all for watching. If there are any questions we didn't get to or any burning questions you have, do feel free to email, tweet, find us on social media, and we will try and answer the rest. Thank you very much.